Alrighty, so hi guys, my name is April. I co-host Windy City REI with a couple of really nice couples. So Chris and Angela. Chris is not here. Me and my husband, Chris and Shalor, are also here. They're gonna start helping us out running this meetup, so we can whip hello to them and their two beautiful girls right there. And so we want to first thank Navigator Tap Room for letting us use their space every month to host this meetup. We really use this so that we can connect people together, help you throughout your real estate journey. And I'm really excited about today's guest because we actually met Rich at a real estate conference here in Chicago. And ever since we've met him, we've been able to leverage his relationships to find people that we need to speak with. Whenever we have a missing link in a deal that we're trying to do, we're like, who can we ask? Because it's not about what you know, it's really about who you know. And Rich has a huge network of people that he can connect you with. And then he's introduced us to Kevin, who has helped us with our real estate taxes every year. And he's helped a lot of our friends as well. And so we're very excited to introduce you to them and their network. I'd like to introduce Rich and Kevin from CBIZ.
Thank you, April. Welcome, everybody. Yeah, April's right. I don't know anything, but I do know a lot of people. So it's gotten me this far. So I know golf as well. I'm not any good at it, but I do know it. Hey, just out of curiosity, how many people have been to the meetup before in the past? Okay, so good handful, good. April and Angela, Chris and Julian, in my opinion, you guys do a great job. I think this is a great meetup to have. Obviously, there's a lot of resources, a lot of information that can be had out of this. So we always try to support you guys and appreciate what you guys are doing as well, too. So as April mentioned, my name is Rich. Kevin and I are with a firm downtown Chicago called CBIZ. I'll tell you a little bit more about who we are and what we do, but I'm responsible for maintaining client relationships, also for handling new client engagements as well, and then leveraging my network, as April already told you as well, for clients that need help. I've been with the firm for about 8 years. It'll be 8 years May 1st, so it's coming up, I know, right? I think we have a good story to tell. We definitely have some interesting things to talk about today, but I'll let Kevin kind of introduce himself and tell you a little bit more about his experience, and then you'll be hearing from me back here in a second. So go ahead, Kevin.
All right, I'm Kevin Chiappetta. I've been at CBIZ for 22 years at this point. I graduated from University of Illinois and kind of just liked what I was doing and continued doing it. And I do work heavily in real estate specifically. Our local firm here in Chicago definitely focuses on that. And when Rich, came out to these groups and met some people, introduced me, it was a good fit because I work with people like yourselves. I've been tasked today with talking about 3 topics that I think you could talk hours about. So I've tried to break it down into what I see from people getting into real estate that aren't necessarily accountants, and some of the, trying to tell you how to understand some of this stuff so it makes sense, and maybe you can use some of these tools to help you in your journey in the real estate market. So the first thing that, sorry, am I not talking into this? The first thing that we want to talk about here is cost segregation studies. And I think the important thing, at least from my perspective, to understand is the basics of depreciation before you really understand what a cost segregation study does. So depreciation is simply just recognizing the cost of your asset over its estimated useful life. All right, so that's kind of heavy. What is an asset and what is an estimated useful life? These are prescribed by the IRS. Generally an asset, you can think of something that's going to last you for multiple years, like a building, right? Or an appliance, or some land improvements, things like that. What are the estimated useful lives? Again, those are prescribed by the IRS. So a residential rental building would be depreciated over 27 and a half years. A commercial building would be 39 years. Appliances, so think your fridges or your stoves, those would be 5-year property. Land improvements are 15 years. That's things like sidewalks or parking lots, maybe some lighting, exterior. So if you bought a $100,000 building and it was depreciated over its 27 and a half years, you would get, $3,500 of depreciation every year for the life of that building. If you bought $100,000 worth of appliances, you would recognize those over 5 years, so that'd be $20,000 of depreciation every year. So obviously getting these assets into shorter periods of time can accelerate the amount of depreciation you're getting on that cost outlay that you've had. So if you buy a building, it's very difficult to break out those assets into anything but building, right? So if you bought a building for that $100,000, you've got a $100,000 building and that's it. What a cost seg does is try to break those assets into their appropriate categories. So you may have a cost seg study that'll say, hey, 60% of this purchase is a building. So on that 100,000, now you've got 60,000 building. And the other 40%, 20% of it is 5-year property, and 20% of it is 15-year property. So now instead of depreciating that $100,000 over 27 and a half years, you've shortened that. Why is that important for you? Well, if you have, let's say, simplify, $30,000 of rental income, and you've got $15,000 of operating expenses, you've got $15,000 of, we'll call it cash flow here, but income, right? You would pay tax on that income. You would, you would have the $15,000 in your pocket, but you're paying tax. What the cost seg will do is allow you to take more than the $3,500 if it was all 27 and a half year, and potentially reduce that $15,000 to zero. If it was all 5-year assets on $100,000 of assets, you would have $20,000 of depreciation. Instead of $15,000 of income, now you've got a $5,000 loss. You still have the cash in your pocket, but you're not paying tax on it. So that's simply what a cost seg is trying to do, is accelerate the depreciation that you would normally get so that you have cash up front to use on more investment or on some of the fix-ups that you need for this property. Now, there's some complications with this, and I don't think this is probably the appropriate place to get into because you could talk for hours on it. If you're a real estate professional, do you get to use the losses, things like that. But on my simple example where you take $15,000 of income down to zero, you can see where there is a benefit to that, that transaction, to get that accelerated depreciation. The other thing about depreciation is there's something called bonus depreciation. What bonus is, it's a made-up thing by the government to encourage investment in real estate. So what they've allowed is some of these shorter asset lives, like 5-year lives, think your appliances, or 15-year lives. At one point, it was 100% bonus depreciation. So instead of, let's say it's a 5-year asset, you bought $100,000, instead of $20,000 a year, you could take $100,000 in year one. That's pretty great, right? unfortunately, with the Tax Cuts and Jobs Act, they have a sunsetting provision in there for the bonus depreciation. So it started at 100% and it keeps going down. This year, I think it's 40% we were just talking about. Next year, it's 20% and then it's 0. You know, I'm not a mind reader or a fortune teller, but I would guess because these provisions have been around for so long and it's very lucrative and the current president is a real estate person, that there's probably a lot of push when the new tax bill comes out that will extend these provisions at some level. So, I mean, even without bonus depreciation, you're still shortening the lives of the depreciation on the assets that you've purchased. But with bonus, it adds another significant oomph to that shortening of the life because you could potentially take a substantial amount of it. So, you know, why doesn't everybody get a cost seg study? Well, there's a cost to it, right? You know, it depends on the building. It depends on, you know, does it actually drop you from an income situation to a loss situation? And those are things that are going to be on each individual's, you know, circumstance is going to have to make that determination. But the reality is, there's generally always a benefit to shortening the lives of depreciation in those cases, especially to reduce your income. I think there's probably, you know, an analysis that needs to be done on everybody's individual level, and it just depends on what kind of income you're projecting for your property. Does the depreciation make sense? But certainly a cost segregation study is one tool that you could use to reduce those lives. It's not the only tool. You could try to go through, if you're building a building, and determine which portion is 5-year assets and 15-year assets. You can certainly do that yourself. You can use an accountant to try to help you. But a cost seg study is performed by an engineer. They have a backed up package that they'll deliver to you that shows you the reduced depreciation, and those companies generally can support those conclusions to the IRS in case they ask the question. So that's the important thing, is you're getting a little bit of comfort knowing that those guys have your back because they're going to back up the product that they've delivered to you. So again, I think, you know, it's important to kind of see what you're saving. You know, why are you spending money to reduce depreciation lives? Because over the life of an asset, you're going to get the same depreciation. But I think it's important to just understand the time value of money, and that taking this up front can generally benefit you from a cash flow perspective. And I think it kind of fits into what I want to talk about with this second kind of thing you guys wanted me to touch on, which is, are there deductions and credits that are out there that I see people missing? It's kind of loaded, but you know, generally to get a deduction, you need to spend money. So there's not something out there that's like, oh man, I can just take a $100,000 deduction that I didn't know about. It doesn't really exist, right? You've got to spend money to be able to reduce your income. I mean, that's kind of the simple thought process. There's some credits out there, specifically around like energy efficiency, putting on a roof or installing some energy efficient windows. You can get a credit. But from what I see, it's generally still not worth the cost to install those, to figure out the credit that you're getting and to make it worthwhile. The dollars just, unless you're installing an energy efficient roof already to be worried about, should I get a credit for it? It's not necessarily a thought process that I encourage people to go down. What I see is the biggest issue with, we'll call it, you know, people delving into the real estate industry, is not keeping good enough records for the expenses that they already should be taking. There's a couple parts to that. One, I think it's important to capture all of those costs, right? It's very easy if you go out and you've got a business credit card or you've got a business checking account and you see the money coming out of there. You record that, that's generally a deduction. What's not so easy, and what I see people miss, is you might have an escrow for your bank account. Well, you're not reconciling that account. There's costs coming out of there that may be deductible. Or you may have a personal card that you occasionally use to go to Home Depot and buy some, screws or something that you're just not picking up as part of the business. That's where I think a lot of, I'll call it small real estate investors, are missing out on the most deductions. I think it's important to have, it's hard. I'm an accountant, so this stuff is kind of easy to me. But I think it's important, if you're going to get into real estate, to have at least some understanding of accounting. Whether it's you take a class or you hire somebody that is a bookkeeper in particular that can help you to record the activity that you are performing. Because I think there are potentially very large dollar amounts that are being left on the table. The other thing related to that is just making proper business decisions. Let's equate it to the first topic. If you're determining whether it makes sense for you to accelerate depreciation to reduce your income, well, you should have a good understanding of what your income is before you make that determination. When I get records from my clients, they give me an income statement that shows they've lost money for the year. And I'm like, okay. So I start looking at it, and I'll see that, they have a line item for entertainment, right? Well, that's not deductible. So right there, that line item is getting added to your net income. They may have a line item for meals, all right? You can have business meals, sure, but those are only 50% deductible, so that's an add back, right? So now all of a sudden, you've got a loss that maybe has turned into a little bit of income because you were anticipating incorrectly on your net income for the year. The other difficulty is, somebody hands me their income statement and I say, oh, you owe tax. They're like, why do I owe tax? Well, this was not deductible. This was only 50% deductible. I'm sorry to surprise you like this. But, those are some things that you need to be aware of when you're creating your, income statement that could be wrong. The other thing that I see, if you buy a property and you have a mortgage on it, all right? So a lot of the times I'll just see the mortgage or the purchase of the property is $100,000 on, and that's what you're telling me. But if you look at that closing statement, there's costs to get that loan. Those costs are amortizable, same concept as depreciation, over the life of the loan. So if you've got $10,000 of loan costs and you've got a 10-year loan, that's $1,000 a year you can be deducting. Otherwise, it's just gone because you didn't pick it up. That can go the other way too. The closing statement will oftentimes have a lot of prorations for rent, prorations for real estate taxes. Those potentially are income items that you need to pick up that if you don't provide your CPA with the closing statement or you're preparing your own return, you're not picking up. So, will the IRS catch that? I don't know. But the reality is if they audit your return, they're certainly going to ask you for a closing statement and say, hey, you guys didn't pick up this income on the real estate taxes or the rent that you should have picked up for that month that you had it. So I think there's a lot of areas in just basic accounting. I call it basic accounting, but accounting or expenses that you have a right to take that you're just not taking. And I think once you get to a place that you've got clean books, you've got a balance sheet that shows all your assets and liabilities, and you've got an income statement that reconciles down, then you can start focusing on maybe some of these other things that are out there more appropriately. The cost seg study, or maybe it makes sense to do these energy efficiency, this energy efficiency work that you may be eligible for a deduction or a credit. But I do think it's important to try to get those records to a place that you can make the proper analysis, your accountant can do your return properly, or you can do your return properly before you start focusing on these deductions that may or may not exist out there. I think there's a lot that's being left on the table when it comes to reconciling your own records. I think that's probably good.
1031s.
Yeah, 1031. So 1031 exchange is really just a section of the code, 1031. What it ultimately is exchanging your property for another property to defer the gain that you would have recognized if you had just sold it. It doesn't get rid of the gain, it just kicks the can. It's a very powerful tool potentially. I've seen people do a 1031 exchange into another 1031 exchange into another 1031 exchange for 40 years, never pay tax on the gain, which is huge, right? You got 40 years of appreciation on an asset or on all these assets that you've never paid tax on. It's very powerful. There's caveats with it. Caveat number one is, if you ever need the money out of that property, you've got a huge gain down in the future that you're going to need to recognize at some point if you need to sell it. Essentially, if you keep 1031 exchanging properties, the only way to really, you can either try to finance it and get cash that way, but the biggest tool is to die with that property and pass it on to your heirs, because they'll get a step up in basis, what's known as a step up in basis, and that gain may just completely disappear. So a lot of wealthy people, very wealthy people, I will say, can buy the property, never pay tax on it, turn it from a 3-flat in Wicker Park to a 50-unit building somewhere, and pass it on to their heirs with no gain, and their heirs' basis in the property is the fair value of that property when they die. So it can be a very powerful tool. If you're looking to hold for a long time and be in real estate for a long time. If you think you're going to be out of it at some point, you really need to think about the benefits to you. Certainly short term, it can work out, but if you need to pay the tax man at some point, you've kicked the can into potentially a worse situation for yourself, because you got to come up with the cash to pay the tax. So let's talk about kind of the basics of a 1031. There's a lot of different ways to do a 1031 exchange, but the most common is to sell your property and then buy a replacement property. All right, there's reverse 1031 exchange or simultaneous 1031 exchange or drop-in swaps. You'll hear all these terms with it, but the simplest is you sell your property, you go buy a new one. If you sell your property, you have 45 days to identify replacement property that you will use for the 1031 exchange on that property you sold. And then you have 180 days from the day you sell your property to actually close on the new property. If you don't meet those requirements, it's not a 1031 exchange. You're also required to have what's known as a qualified intermediary. A qualified intermediary is, think of it like an escrow agent, right? They hold the funds so that you never see them. And they'll hold it on your sale, and then they will put it into the new property so that you never touch the money. Now, I think with the qualified intermediary will help you through some of the rules to make sure that you're following them. But I think the qualified intermediary, first off, must be an independent party. Can't be an investor, can't be your friend, I guess it could be your friend, but it can't be like a relative. It's got to be a totally independent party. And you've got to replace the property that you're relinquishing with property of equal or more value, okay? If you don't, then you have to pick up some gain on the difference between those. You also have to replace the debt. So if you get a reduction in the debt, that counts as cash going to you, and you would have to pick up gain on that portion of it. Same as if you get cash coming out of the sale, that's gain to you. It's known as boot, and you would have to pick up gain on a portion of it. So a portion of that 1031 may or may not be deductible depending on whether you got less debt or whether you got some cash out of it. So those are some important things. You want to exchange into a larger property. The other thing that I think is important is you've got to follow the rules. Like it's just provided by the IRS, and you've got to step through them. If you don't, the IRS could come and say, that's not a 1031 exchange, you didn't follow the rules, you've got to pick up gain. Which really sucks when you've sold your property, put all that money into a new property, and they tell you that wasn't a 1031 exchange, we need this cash right now for the tax that you owe on that gain. And you've got it all locked up in this other property. Now you're either stuck selling that or coming up with cash some other way. So it's important to follow the rules to make sure that you're eligible for this. The other thing to think about is if you're only going to hold this property for a few years, capital gains rates are not the same as income tax rates, but they do graduate depending on income level. And if you're at an income level with the gain that is relatively low right now, and you're going to sell this property in 5 years, but you're kicking this gain down for 5 years, and now you're in a higher bracket and you've got to pay the tax on a much higher level, maybe that wasn't worth it in the first place. But again, every individual is different. You got to kind of analyze what your thought processes are going forward and what you're looking to do. The other thing to think about is there's a cost to all this. You've got a qualified intermediary. You may have a lawyer to help you out. You may have a CPA that helps you file the correct paperwork with your tax return to report the 1031 exchange, to calculate the actual deferred gain, to track the basis on your original assets, the depreciation, all of that stuff needs to be reported to the IRS. There is a cost to that. Is it astronomical? Probably not, but it is a cost to doing this. So again, if you're 1031ing for a short term, it may not be worth it for you. It may be in your best interest to just sell the property, for instance, if you want out, or just be aware that there are some costs that could potentially come back at you, or there will be some upfront costs that you have to deal with. But again, I think it kind of ties into the second part, and even the first part, the bonus depreciation, the accelerated depreciation, the deductions, that all these things come down to making sure you've got pretty good records so that if you are ever audited, you've got support for everything that you've done, you've got support for the basis that it is that you're kicking into this new property. And I think it's a great tool, but it just depends on what you're using it for. And I think, there's definitely a lot of people that will hear something like this, and I certainly don't want you to all run out and start doing 1031 exchanges. I think it's important to, if you've got an accountant, talk with them, see if it makes sense. Are the dollar amounts that you're trying to defer worth the cost to defer them? Same thing with the cost seg. Are the costs of doing a cost seg worth accelerating depreciation that you were going to get anyway, just not as quickly as you're trying to get them? But like everything, there's caveats. There's different tax laws depending on anybody's situation. One thing we didn't talk about that I don't think we necessarily should is being a real estate professional. That's a very important aspect to tax planning potentially, because if you're not a real estate professional, you may not be able to take any of the losses that we talked about on deductions or on depreciation because you're known as a passive investor in real estate, and that may change the decision on whether you get some of these things done.
And the IRS looks at a real estate professional. There's certain guidelines for that. What is it, 750 hours? So you have to dedicate 750 hours a year to be qualified as a real estate professional. So if somebody just says, well, yeah, I do this, I do that in real estate. Yeah, but do you have the amount of time necessary? So that's important, because a lot of people don't understand, or maybe they have a W-2 job and they have these, as they call them, side gigs. It's probably going to be tough to kind of push that through the IRS and not be considered as a real estate professional. We get that question all the time.
Yeah, certainly. And if you are a W-2 person with a full-time job, you have to spend more than half of your time in real estate to be considered a real estate professional. It's very difficult to overcome that hurdle when you've got a 40-hour-a-week job.
Yeah.
So, it's just another thought process to go through. I would certainly encourage you, if you are filing your own returns, to look at the rules a little bit closer on the real estate professional. Look at your records. Make sure that, you are capturing all of these. Don't worry about some pie-in-the-sky deduction out there when your records aren't clean enough to take the deductions that you should already be getting. Those are the important ones to actually grasp and to make sure that you're recording. So I think that's kind of what I wanted to go through. Yeah.
We'll take questions here in a minute, but, bottom line, and I'm assuming everybody's kind of in their own different stage of real estate investing or in their own real estate world. Pro tip here, one thing that Kevin and I would say, seek a professional, seek somebody who has experience, seek somebody that's going to be proactively reaching out to you and doing more than just a tax return for you every year. They're going to be reaching out to you, talking to you about some of these opportunities, some of these advantages that you should be looking at, some of these deductions you should be talking about or thinking about. And certainly take the time to vet some of these folks out. I've come across a lot of clients or clients of former firms, and yeah, they told me they had experience in real estate, but they didn't know what a cost seg study was, or they didn't know what a 1031 exchange was. There's some of those folks out there. So seek good professional help. Really do your time vetting those folks out. Make sure you're picking the right type of firm. Again, proactiveness, experience is always a help, and that can really help determine the success that you guys have from a tax perspective. At that point, is there any questions at all? Does anybody have anything? Yes, sir.
In regards to the 1031, can it be an LLC? If there's a house, and then they can go buy a multi, and if so, they have to keep it until they die. But what if the tenants living in that multi, they do a land sale? Will that be okay then? Because when they die, it goes to them.
Remember, I don't know anything, so I'm going to hand it over to Kevin.
No, an LLC can certainly do an exchange. A like-kind exchange is simply one piece of real estate for another. It could be land for a rental building. It could be a rental building for a commercial building. It could be a 3-flat for a 50-unit building. It can't be international property, so keep that in mind in case you were thinking about it, but it can be property anywhere. You don't need to hold it till you die. That's just to continue to defer the gain. So if you needed to sell it at some point, you certainly could. For an LLC, if it's got partners in it, you may have to make sure that all the other partners want to perform that 1031 exchange. If they do not, there are ways to get the property out of the LLC to perform the exchange for the individuals that do want to do it. That's known as a drop and swap, where you drop the interest in that property to the individual investors, and then the individual investors that want to be a part of the exchange would have to have the intermediary and be a part of the new purchase. As far as having tenants in the building, it doesn't really matter.
Because is your tenant nice to everybody's wife? Because I could form a land contract so that upon my demise, it goes to you without, and then you would not have to be engaged with this.
I guess I'd have to think about that one, but you're essentially giving them the future. I mean, you're putting that property in a will or something to give to the tenants. I don't think that changes the nature of the exchange. So I think that would be fine. But keep in mind that an exchange has to be with business property or investment property. So you can't do this with your personal residence, okay? You can't do this with your second home that you occasionally live in. It's got to be investment property or business property to be able to even do this exchange. But in the case where you're not living there, you've got some tenant that you're going to put in your will to give them the property upon your death, that doesn't change the nature of the transaction, the 1031. I mean, you could run into like related party rules if you're exchanging with a related party. There's some other things that you want to think about, but I don't know those rules off the top of my head, and I wouldn't want to talk about them, but I don't think there's a problem with that.
Anybody else? Questions? Comments? Concerns? As they say. I'll say one last thing.
Yeah.
Hearing nothing? Okay, thank you. The reason I want, just in closing here, thank you for coming out today on this bright, sunny Sunday afternoon. Appreciate you spending your time here with us, talking about the exciting world of real estate taxes. And thank you to April, Angela, Chris, and Julian as well for having us come out. I think we've been bugging you guys to do this for a while.
So excited.
But we appreciate you guys having us out and appreciate you guys coming out. So thank you again. Have a good rest of the afternoon.
All right, that was really awesome. I know you guys have some built-up questions somewhere, so make sure to network with them if you're too shy to ask your questions up on the stage. Before we start networking, if we can just have everyone buy the beer tap so we can take a quick picture, and then we can start meeting. Thanks, guys, for coming out. Thank you so much.
Yeah.
Thank you. I need to get my text up. No, that was awesome. You have so much information in this head of yours.
You do.